JPX energy market weekly updates. In today's video, I'd like to make a brief introduction of the summary and outlook of the oil market in 2022 and 2023 to help you understand the crude oil market landscape as this year's turmoil and volatility draws to a close. On the demand side, world oil markets are rebalancing after the COVID-19 crisis spurred by unprecedented collapse in demand in 2020. According to the IEA, by the end of 2022, oil consumption and demand in Europe and the United States have basically recovered to the pre-pandemic level. Asia has also recovered by more than half. Looking ahead into 2023, oil consumption will continue to grow, but the overall increase will slow down. The energy crisis caused by the Russian-Ukraine war has had a profound impact on the European economy, while high inflation remains a threat to the U.S. economy. Demand growth from the West is expected to be largely stagnant next year. At the same time, Asia will dominate demand growth next year, with China and India providing solid support as consumption drivers shift eastward next year. While demand growth comes to a standstill in all major products, the only exception to this lackluster outlook is jet fuel. The recovery in jet fuel consumption has already begun to gather pace during 2022, with the number of daily commercial flights globally topping 100,000 at one point during the summer peak travel season, according to Radarbox. That is a 87% of the 2019 level and a 27% year-on-year increase. On the supply side, global oil supply increased by 4.7 million barrels per day to 100 million barrels per day in 2022. As of October, global supply levels have roughly recovered to pre-pandemic levels. OPEC Plus members contributed most of the increase, with Saudi Arabia increasing its production by 1.6 million barrels per day. The United States increased production by around 1.2 million barrels per day as producers continue to focus on generating cash flow for shareholder returns. Supply chain disruptions and rising costs due to inflation have kept U.S. shale oil production growth at a slower rate, with production still not exceeding its 2019 peak of around 13 million barrels per day despite the rally in oil prices. In addition, the U.S. and other IEA members have contributed an average about 1 million barrels per day of oil supply to the market through selling SPR since March this year. At the end of this year, the U.S. announced its first plans to buy back reserve. The shift from selling to buying reserve next year will also tighten supply. Global oil supply is expected to increase by 800,000 barrels per day next year, significantly slower than this year. The increase is mainly contributed by non-OPEC Plus countries. The U.S. will add about 1 million barrels per day. OPEC Plus supply, excluding Russia, will only increase about 300,000 barrels per day. With the European embargo on Russian oil product coming into effect on February the 5th, Russian refiners could be forced to cut production, with major international agencies forecasting a decline of around 1.4 million barrels per day next year. On the refining sector, diesel has been the core of refining industry in 2022. A contraction in global refining capacity and lower levels of Chinese export, together with an increase in consumption, contributed to a continuous fall of diesel inventories. Since the outbreak of Russian-Ukraine war, diesel crack spread soared to about $70 a barrel before eased to $40 a barrel. Global refining margins increased significantly. We expect diesel crack spread may get some support at the beginning of the year amid Russian oil product embargo. However, supply from China and Middle East may continue to rise. Supply from the United States will remain high. Diesel crack spread may hardly exceed the peak level in 2022. Refiners will continue to enjoy relative high profits from middle distillates where jet fuel and diesel are located in 2023. However, production margins for other oil products may get squeezed by a passive increase in supply. According to the balance sheets of the IEA, EIA, and OPEC, world oil demand recovered to around 101 million barrels per day. Demand for OPEC crude remains stable, averaging between 29 to 30 million barrels per day as non-OPEC supply increases. Given the difficulty in increasing production in some OPEC countries, we believe it will be difficult for OPEC to produce more than 30 million barrels per day under the present production mechanism unless Iranian crude returns to the market under the new deal. As a result, the market may remain tightly balanced or slightly under supply next year. The spread between Brent and Dubai crude oil has remained high this year. The spread reflects tighter supply and demand conditions in Europe than Asia, but also the difference between sweet and sour crude quality amid high natural gas prices. Next year, with demand from Asia rising and OPEC maintaining production cuts, Asian markets could tighten again and the Brent and Dubai spread may trade at a lower price range. Okay, that's all we have for this week. Welcome back next week.